Awesome. We are live. Welcome, everybody. I'm going to take a quick moment just to make sure that I am streaming everywhere, and then we will get started. Thankfully, this will give everybody a little bit of time to also congregate here, especially Facebook audience. You know the drill. Come comment, leave questions, come hang out. This is significantly more fun when there's a dialogue going on. And I think that we have a ton of really interesting stuff to talk about today that probably is going to have a pretty legitimate effect on markets, on people's lives, on any number of things, depending on where you're at and what you're investing in and things like that. So really looking forward to this chat. And yeah, let's get started in just a moment here. Yes, looks like we're streaming everywhere. Awesome. Cool. So today's lesson plan. First, we're going to talk about whether or not we're in a risk-off environment, or also known as a bear market. You can call it an accumulation phase. You can call it a downtrend. There's any number of things you can call it, but simply prices are going down rather than up. It's a risk-off environment, right? We're going to talk about Federal Reserve policy and the effects that that has on markets and what might inform the markets shifting to a more risk-off environment. We're going to talk about the Ukraine and Russia's impact on markets. I am not an expert in geopolitics. I am not an expert in foreign policy. I am simply an economist here to talk about markets. So I'm not going to be giving you my opinion on Russia and Ukraine. I'm going to be giving you my opinion on the impact of that particular geopolitical situation on the economy and markets as a whole. Finally, we're going to talk about commodities markets, which are things like gold, silver, oil, the bond market, stock market, and of course the crypto market. So really looking forward to our lesson plan today. Looks like we already have quite a few watching, which is awesome. What's up, Hannah? What's up, Steven? Excited to get started here. Let's move. Okay, so first thing, welcome to the bear market. This is Hank the Tank. Apparently, he's a very, very overweight bear that was messing around in some areas of California. And I don't know. I really liked this picture to kind of emphasize what a bear market is supposed to mean. So bull and bear markets, right? We hear these all the time. Bull markets mean prices generally moving up, bear markets is prices moving down. But these animals, to describe these two things, represent something, right? Bulls charge. They go until they see red, and then they head out, right? Bears hibernate, they accumulate, right? So they sit around and they buy and they just get more and more and more of whatever assets they are that they're trying to accumulate until the next bull market kicks off, right? People view bear markets as a bad thing. I don't really think they're necessarily a bad thing if you have one, the right mindset, and two, the right strategy, and you're not overextended into the market, right? You're managing your risk properly. Where those risk levels are at for you, what your financial situation is, that is not mine to speak on. All I can say about it is that bear markets are amazing opportunities to make money if you play them correctly, right? Most people, Shane, I apologize. I don't have any riffs for you today. I do have, riffs in economics that are pretty juicy, but no guitar ones, unfortunately. However, you can see, my two instruments in the background there. But anyways, to continue, so, a lot of people get into the market for the first time during a bull market because it's exciting. You see price going up, you hear about all these people making money, everybody's, celebrating and in a good mood about everything. And then a lot of people will permanently exit the market during the bear market, right? They won't be buying, they're not interested, they're bummed out that all their investments are down and things like that. And that is the worst mistake you can be making, right? Uh, Consistent strategies and consistent buying strategies over long periods of time is where the real money's made. And that's really important to know. So again, this is also called a risk-off environment. This is also called a downtrend. This can be called an accumulation phase, whatever you want to call it. The point is that we expect prices to trend downward in a bear market. That doesn't necessarily mean forever. That doesn't mean, I'm not saying it's months. I'm not saying it's years. I'm not saying it's decades. I'm simply saying that right now we're in a downtrend, and I will kind of show you how we go about defining that in just a moment here. So there's two ways that I personally define a bear market. It's a very subjective term, right? Because if price goes down for 3 weeks, was that a 3-week long bear market? Probably not, right? So there's two things that we can use to kind of see whether or not we're in a bear market. Moving averages and moving average crosses are one indicator on whether or not we're going to be in a sustained downtrend. And the other thing, which I think is just more useful as far as the definition of the term bear market, is higher highs and higher lows versus lower highs and lower lows. And I'll explain exactly what that means. Also, in reference to consistent strategies, right? Hannah's saying dollar cost average, dollar cost average, dollar cost average is the best way to persevere through these rougher times in the market. So let me show you what I mean by higher highs and higher lows and lower highs and lower lows. And let me just get my blank Bitcoin chart here without all this noise on it and get rid of the moving averages for now. So what this idea of higher highs and higher low means is that when the price goes higher, it's going higher than the last high. And when the price goes lower, it's going lower than the last high. I'm actually going to switch to my bar charts, or, the Heikin-Ashis will be great. Yep, cool. So you'll see we hit a high, hit a low, we hit a higher high, we hit a higher low, right? This high is higher than this high, this low is higher than this low. We hit another higher high, we hit another higher low, hit another higher high, and then we hit a lower low, right? This low here went lower than this previous low. Then we put in a lower high. And the market's reaction to seeing that the trend was changing from higher highs and higher lows to lower highs and lower lows was, oh, we're headed into a bear market. And that caused a pretty ugly capitulation event. And then we saw lower high, the lower low, until we finally broke that downtrend and went into a different market that you could then at that point consider a bull market, right? And again, like, this is subjective, but I think you can pretty reasonably say that this range here was a bull market. This range here was a bear market. This range here was a bull market. And this range here is currently a bear market, right? And we don't know how much lower that's going to go. We don't know if it's going to continue. All we know is that we are in a consistent downtrend, right? So something that's important to recognize. And, Bitcoin's my favorite asset to kind of teach some of these things on. I think the story that Bitcoin has told over the past year and a half is really interesting. But the reason why I'm saying we're in a bear market is not because Bitcoin's in a bear market. Bitcoin's been in a bear market for a while. Why I'm saying this is because stocks are showing downtrend momentum, right? So again, we had, let me grab my drawing tool here. Higher high, higher low, higher high, higher low, higher high, higher low, higher high. Those are lower lows, right? First time NASDAQ's been putting in lower lows in a long time. Let's see the last time that we got some lower lows. Looks like, yep, the 2020 capitulation was pretty much the last time that we got a legitimate lower low. Right? So we've essentially been in a bear market, or a bull market since like April of 2020, more or less. Padre said, let's go. Some technical analysis. Yes. And just, talking basics here, right? And we'll do some deeper analysis on some of this stuff in a bit here, but towards the end of the stream. But simply put, this is the first time NASDAQ's put a lower low in 18 months. That's a pretty big deal. And that's obviously a lower high then, right? The Dow Jones, yep, just put one in today as well. And the S&P 500 did a little, but just yeah, I'm not gonna 100% call that definitively a lower low yet, but if we see continued downtrend momentum tomorrow, it's gonna be a lower low, right? So first time all of these very major indexes have put in lower highs and lower lows in about 18 months. We can consider that a downtrend, a bear market, whatever you want to call it, right? So why is this happening? What are the things that cause such a thing to happen, right? Like, what are the implications of a risk off environment? Why is that happening? And I'm going to go to my note sheet here just to make sure that, yes. So, what are some conditions that can cause a bear market? The answer is that a lot of it, not all of it, has to do with Federal Reserve policy. The Federal Reserve has been hinting that they are going to raise interest rates for a good 4 to 6 months now in order to get inflation under control. And if you want to learn more about inflation and the inflation situation with that, I have tons of both live streams on Facebook, and I also did about a 25-minute video dedicated purely to explaining some inflation mechanics and some things to know about inflation. So you can check it out there. But pretty much with Federal Reserve policy, there's two ways that we can look at it: expansionary policy and contractionary policy. Generally speaking, the Federal Reserve will embrace a more contractionary policy when economic recoveries are happening or the economy looks a little more stable, while they'll lean into expansionary policy when we're in recessions and there's fear going on in the economy and the markets. So, what is expansionary and contractionary policy? Well, it's basically set with interest rates, right? That is the primary way that we go about practicing expansionary and contractionary policy. Taxes also have something to do with it, but right now we're going to focus on interest rates. So, the main thing to take a look at is that when the Federal Reserve raises interest rates, they're soaking liquidity out of the economy, right? So they're going to be trying to reduce inflation through this, right? They're making access to money more expensive, literally, by raising the interest rates. They're just trying to cool off the market a little bit. And the reason for that is because then when those recessions hit, they're a little bit more eager to practice expansionary policy, which is a lowering of interest rates, right? It makes it easier to put stimulus into the market. Usually you'll see unemployment and other forms of welfare expand during this time period, like we saw back in 2020, right? We lowered the interest rates, we made money more liquid. There's a lot of debate on whether or not this is actually helpful, right? I'm a I'm a big proponent of the Austrian School of Economics, and they say that this causes a boom and bust cycle and it causes malinvestment. And what that means is that when you practice expansionary policy, people get blinded to what actually has value because there's so much liquidity in the market. By liquidity, I literally mean there's just more money in the market, right? And for all examples here, um, a lot more money in the market, right? As of March 2020, about 43% more money in the market. That's a lot. Um, so people just start investing in stuff, right? Because they want a place to put their money. A lot of the time, they'll expect their money to be devalued in that time through inflation or whatever because we're expanding the money supply. So they're trying to shore it up in assets that will appreciate in value so that they can protect their dollar, right? So with that comes this malinvestment idea of then when you suck that liquidity back out of the market, a lot of floors come out, and maybe the things that you thought had value don't have quite as much value. So just something really worth looking at because the markets are absolutely reacting to the idea that the Federal Reserve is going to practice more contractionary policy rather than expansionary policy in the near future. And by near future, I mean, I think our first interest rate hike is supposed to be next month. But that's the funny thing to me is all of this talk, all of these people getting scared, all of these people yanking their money out of the market, and we haven't actually raised the interest rate yet. So and I've mentioned this before, right? So human psychology will price in expectations, future expectations, faster than those things actually becoming a reality are, right? So people are expecting higher interest rates. They're expecting, the contractionary policy to take place, which makes these assets a little bit more scary to invest in. They want to get a little bit more risk off getting out of the market, right? Simple as that. And with that comes this crazy downtrend that's happened before the contractionary policy even takes effect, right? So it's pricing in future rate hikes. And as you can see, I mean, the Federal Reserve's interest rates have kind of just been in a downtrend, right? We basically had them, uh, uh, meaningless from 2009 to 2016. We started to sort of incrementally get them raised up to about 2019, and then we had to kick in emergency interest rates in February of 2020, and we went right back down to where we were at the prior recession levels, right? Um, but because inflation's bad and things like that, we're probably not going to go like another 7-year stretch of incredibly low interest rates. We're going to have to start ticking those up again. But the thing is, and I think this is important to mention, is that like the markets overall did fine in this like 4-year stretch, right? Like it wasn't, there were bear markets. I think 2018 was especially rough. But overall, like, it really wasn't that bad. I'm going to switch to some comments real quick. Kavandre says, no more Trump dollars, stimmy grants, smart money on the sidelines, emerging growth stocks taking huge hits. Yes, this is all accurate. And we'll kind of talk about what exactly all of that implies in the not so distant future here. A lot of fear, uncertainty, doubt for sure. Interest rate increases got peeps scared. Yeah, and that's really what it is scared, right? The interest rate increases haven't happened yet. So a really interesting chart in reference to this, and I'll explain this for a second. I also showed this chart in my interest rate video. Is here's the interest rate, right? This dark blue line, and these little like wisps that you see are expectations in interest rate hikes, right? So this is the market anticipating interest rates, these like blue lines here, and then this dark blue line is the actual interest rate. And the main thing that I notice with this chart is that the market expects more severe interest rate hikes than actual, right? I expected them to go higher here when they went down significantly lower. And then 2009, 2010, 2011, 2012, 2013, 2014, right? They just kept expecting the interest rates to increase and they didn't. And then even at the tippy top of 2019, they still expected them to increase. And then COVID obviously changed that scenario a little bit. And the crazy thing to me is that the most recent WISP here, which is pricing, it's showing the expectation of February, where the market's at with interest rates as of February of this year, right? Massive, massive increase in the interest rate. And yet we've yet to see one. Now we will. We will see one next month. But the thing is that people are projecting between 7 and 10 interest rate hikes over the next 18 months to 2 years, right? And if history is any indicator with that, they're going to be super wrong on it. So we've already priced in interest rate hikes that are probably going to be more severe than actual, right? We're assuming the interest rate hikes are going to be a lot worse than what we're probably going to end up seeing. So something worth noting when you're in a risk off downtrend environment, right? This might not be as bad as people expect. So the other thing that I think is really interesting, and this is probably the most that I'll talk about bonds for the session here, even though I said that I'm going to do that later, is this is the 10-year bond yield lined up with the federal funds rate. And the thing is, well, Treasury bonds and interest rates and inflation aren't all directly associated with each other. Anecdotally, I have a story to tell, right? Back when I was a kid, like, elementary school, I was given Treasury bonds by my family as a gift at some point, right? And I'm sure anybody who's received a Treasury bond as a child remembers hearing the phrase, in 7 years, this will be worth twice as much, right? In 7 years, this will be worth twice as much. I cashed out most of those treasury bonds when I was in college. So between like 9 and 12 years had elapsed, and I don't believe any of them matured to a point that they had doubled in price, right? So that bond yield really is not great. Now, for the first time in a long time, we're actually seeing an uptrend. Pretty big one too. Why? Interest rate hikes, right? Market is now pricing that in. So that's the first point that I want to make about a risk off environment, is that people will move to bonds because bonds are safe, right? Risk off, bonds safe. So with higher interest rates, bear market in the stock market, people are going to move to bonds a little bit more. And as you can see, bonds took a beating when we lowered to emergency interest rates, right? So worth taking a note of. We'll see how they do, when it comes to the actual interest rate hikes, because, we were hiking rates from like 20, about 20, let's say 15 to 2019 here, right? So we can see that uptrend. And then it started to kind of level off and keel over with the emergency interest rates and COVID and blah, 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 blah. And you can see 2008, right? We had a massive downtrend in bonds while we were practicing some expansionary policy, and then it kind of hit a floor when that expansionary policy just remained the same throughout, that period of time. Again, if you are watching, feel free to ask questions. This is a ton more fun when people are asking questions. If anything's confusing, if you need clarification in any way, go ahead and ask. That's what I'm here for, right? But anyway, so yeah, that's the bond situation, right? The other thing that I want to talk about, and again, I'm not an expert in geopolitics or foreign policy, but I do want to talk about this Russia situation. Now, the thing is that when you're in a bear market, every single fearful, situation just adds fuel to the fire. It's not the cause of why the price is trending down. It's just simply an incentive for people to psychologically believe, prices should trend down more. So what I mean by that is just because prices are trending down, maybe as a result of the Russia-Ukraine situation, doesn't necessarily mean that the implications of what's happening there are so bad that they're actually going to have a legitimate effect on the economy long term. The main thing that I am hearing is that Russia has a lot of oil, right? And they do have a lot of oil. They rank third in the world for oil production. They rank fifth in the world for oil consumption. And they have a massive amount of net exports. As it currently states, and this article is from 2 days ago, is that Russia produces roughly 11% of the world's oil supply, 10.5 million barrels a day, right? So people are expecting, and I'm just going to go ahead and be an economist real quick and there's that. I'm going to make this white, going to make this white. There's supply and demand, right? And we're doing oil right now, right? So one of the things that is going to happen is supply might decrease, primarily though for Europe. And naturally, when supply decreases, that is going to reduce the quantity, right? And increase the price, right? And so your equilibrium price was previously here, and now it's up there, right? And sorry for how horrible this drawing is, right? There's price one, lined up with this equilibrium here. And then there's price two lined up with this new equilibrium after a decrease in supply. Hopefully that makes sense. How would a bear market approach your strategy in regards to trading or investing in the stock market? I will get to that momentarily. And what I will provide is not financial advice. It's just options for people to potentially educate. themselves on and make their own financial decisions from there. Um, Anyways, I'm going to do a lot of Control Z here to get rid of this. But yeah, so obviously we have a decrease in supply. Now, the thing is that's really important is that the United States is not very heavily reliant on uh, imports for oil from Russia, which I think in general makes sense, right? You don't want to become close trading partners with people that you could consider, potential issues. I'd say the one exception to that is China, and even then, we've tapered off from production in China as our foreign policy relations have gotten a little bit more rocky over time, and Russia's more of the same. So gas prices probably will increase, and if you actually look at crude oil prices, they are indeed increasing, right? And this whole drama really began, let's say, November here, and there's just been kind of an uptrend in crude oil since people really started considering the implications of, potential Russia issues. And I expect this to continue up for some time, if nothing more than just people psychology pricing it in, right? Again, there's an issue with Russia and Ukraine. There might be less oil floating around and exported, and so increase, of oil prices. But again, America's not insanely heavily reliant on Russia's oil production. So curious to see, what the actual implication of that is. I'm going to get rid of some of these tabs here. Sorry, I get distracted very easily, so I just reducing the distractions as much as possible. So long story short, the actual effect of this foreign policy situation is to be determined because we don't know how severe it's going to get, right? If Russia launches a full invasion on Ukraine, I think the markets are going to be scared because a global superpower is launching a war essentially, right? That's going to cause some shakiness in the markets. It's going to cause some uncertainty. But again, I think the human psychology of those conditions actually matters more than the legitimate economic implications. And I could be wrong on this. I can't predict the future. All I'm saying is that the United States isn't super reliant on oil imports from Russia, right? And we'll see how things transpire here, and we might, there might be alliances, right? The Middle East might side with Russia and decide they're not going to do as much trading with the United States. Who knows? I can't predict it. I'm just saying right now, I'm not super stressed about the effect on gas prices that have, by the way, already been skyrocketing, right? And we know that. We know we're paying a lot for gas right now. Probably going to pay a little bit more for gas in the future. But I don't think this is entirely contingent on what Russia is doing with Ukraine right now. I just think that there's different market conditions at play there. So, commodities in a risk-off environment. Well, we're seeing oil prices increase. And if we go to silver, silver actually just we had a pretty massive breakout back in August, and we've just kind of been accumulating since then. So to be determined here. One thing that's worth noting is the past 3 weeks, it's kind of been crushing it. What you'd be looking for here is, as we've been talking about, higher highs and higher lows, right? You're kind of going to be looking for this to come up here, break this high with some conviction, maybe break above this high, right? That's kind of what you're looking for on silver if you want to, say, okay, this uptrend is going to be sustained. Which, I mean, for silver, like this run up's incredible. Like to go from, 157% in not even a year. I mean, that's pretty amazing for a commodity. So hats off to silver. All you silver guys crushing it out there. And then gold is in the middle of what I think is a massive breakout, right? Gold's essentially been in the same accumulation range for a decade. So you could have bought gold at $1,900 back in 2011, and you didn't hit profit until literally like summer of last year. And then after that, if you didn't sell, you had to deal with a downside consolidation phase. Which, by the way, anybody that knows their TA pretty well, this shape pretty legendary as far as bull markets go. That's a cup. There's a handle. And we're breaking out from it, right? I don't know about you, but cup and handles that have lasted more than a decade, probably pretty reliable shape, right? And why this is called a cup and handle is you have a peak, a rounded bottom, right? Well, we like those round bottoms, right? Which means downtrend and then uptrend, but nothing V-shaped, right? It's nice and sustained and consistent. And then you have a second peak that could be an all-time high, that could fall short of an all-time high. But point is that it's parallel with the first peak, give or take. And then you enter a small accumulation phase. This is, referred. You can call it a bull flag for the cup and handle purposes. It's the handle, right, where you enter this kind of bullish consolidation, and then eventually you break out of that and upside, right? So I'm not really heavily invested in gold. If I had to pick one asset to invest in the rest of my life, Bitcoin versus gold, I'd probably pick Bitcoin. But like, you got to give credit where it's due. The gold guys, after screaming for a decade and watching their portfolio, really bite the dust for a while, finally it's probably breaking out here. And again, I mean, who knows, right? I mean, this might dump, right? But we're in a risk-off environment, completing a decade-long consolidation phase, and headed up with a decent amount of conviction right now. Gold's probably in a bull market. So what did we learn? Risk-off environment, contractionary Federal Reserve policy, right? People are a little bit scared right now, and we're seeing increases in bond yields and commodities. Okay, so things to know in a bear market: bonds, commodities, not horrible places to shore up your assets. Brandon says, I guess now's a good time to cash out those silver dollars I had locked in my safe. Yeah, just don't go selling your mom's wedding ring or anything like that. We like those bottoms. That was the joke. There's a very inappropriate term for the cup and handle shape that I've heard people refer to. Peter Schiff has entered chat. Yes, everybody's favorite Bitcoin bear and gold shill, Peter Schiff, is celebrating, probably a "I told you so" that he's been waiting a decade to post. But it's okay, because he's been wrong on Bitcoin for a year, and I don't see any reason why Bitcoin and gold can't coexist. So whatever. All right. So we got all that done, right? We got through commodities, you got through bonds, and now probably what everybody's a little bit more interested in, because if you've been investing in the past couple of years, you've probably been investing in stocks and crypto more than those boomer, commodities and bonds and stuff like that. So how would bear market approach your strategy in regards to trading or investing in the stock market? So the first thing, right, and like I said, commodities and bonds, right, a little more risk off. You might be more likely to get a return there. This is not financial advice, but overall, those tend to do better when the stock market is in a downtrend, right? Yeah, boomer line go up. The boomers are shouting victory right now because gold's breaking out. That's for sure. But anyways, we're going to go back to our indexes here, right? Also going to crack open a fresh sparkling water, since I've been talking for 35 minutes straight now. So refreshing. Polar Seltzer, if you care to endorse me. I have an infinite supply of orange vanilla flavored seltzer, which sounds weird, but it tastes like an orange creamsicle, and I can't believe there's no sugar or fake sugar in it. So, yeah, there you go. Bipolar seltzer, delicious. All right, so Dow Jones is an industrial index. So I'm not looking to this because I don't think as much speculation is happening as far as the industrial average goes. Still though, lower low, right? Bear market. The NASDAQ, which is tech stocks, it has the most convincing lower low, and I actually believe is down the lowest from its all-time high so far. What just happened there? Give me my, there we go. Yeah, it's down about 20% from its all-time high, respectively. The Dow is down less than 11%. So yeah, the Nasdaq's down over twice what the Dow is down. And then the S&P 500, we're looking at minus 12%, right? And then let's take a look at some of the other tech stocks I have on here. Probably some ones that, a decent amount of people are invested in. Tesla's down a ton from its all-time high. It's down about 40%, and it just broke. I don't know what this white line is here. I was going to say it looks like it's breaking support, but I actually don't know where I'm drawing the support from. Let me go to the daily chart. That's more convincing. Okay, so yeah, so we had, a hold of support here before moving up, it looks like, right? We broke under that back in about this time last year, and now we're breaking beneath that. Probably going to be my guess, and for those that don't know what resistance and support is, resistance is a level that an asset will struggle to break past, right? And support is an asset that, or a level that the asset will find as, maybe a potential bottom before heading back up. Support's a lot more useful in a bull market than a bear market, because in bear markets, you just do nothing but break support. And you're like, oh, maybe this support will hold, please. And it doesn't. And then you're just sad, right? So a couple potential supports for Tesla. Potential. Right down here at this $600 level. Personally, that would probably be my price target. But you can also go, depending on how doomsday situation we get, right? We can go to this accumulation range over here and probably pull, like one around that area. And again, these are like loose, right? This is not for sure going to be like perfect bottom to the dollar, right? These are areas, they're ranges, right? It probably, will look something more like this, right? Will occupy, this general zone or whatever. But yeah, I'd say I'm not going to say worst case, but I'm going to say that like I'll probably, be looking around this area if we, convincingly lose support here and just start trending down, right? Amazon, it's been in a pretty long accumulation phase here since about the beginning of 2020, I'm pretty sure, right? Yes. We ran up actually July 2020, right? So again, we can take, like this, and these again are just kind of general ranges, right? So we've been in this consolidation range for a while. So what I would look for is, this to continue to consolidate. Maybe this loses a bit support, but whenever we're back in this range, I'd like to see it come up, come back down and hold it as support for a while and then head up, right? Amazon's looking in pretty decent shape. And I think, given their role with COVID and how they just keep finding, new ways to provide value in the market, that probably makes some sense here. That space background though. Yep. I got, this little animated space background. And then in the back, you can see I have some Kurzgesagt posters. So Kurzgesagt's a YouTube channel that talks about science, and they have really beautiful animation. And in the back, there's a black hole, the Milky Way galaxy, and like an index of like a bunch of like large suns and stars. Brandon says if Tesla drops to $330, I'm selling a kidney. Yeah, I definitely don't think that's quite as likely. I'd say this $600 level is probably where I'd be putting some bids, but who knows? Google's doing okay, right? Again, like kind of similar situation as Amazon, where you kind of had like this larger accumulation range. If we broke out of it, you'd probably be looking at $2,220 for your next support. But again, supports are kind of a memes in bear markets. So, Then you take a look at Apple, right? And Apple's, got a lot of conviction here, but just along with other tech stocks has kind of been struggling and worth noting, right? Higher high, and then we have a low. We have a lower high, and we'll probably be looking for a lower low there, right? So worth keeping an eye on. And then the greatest meme of 2022 so far, Facebook stock. Let me just line graph this. You can see how bad that is. This is a multi-billion-dollar company that's been around since the early 2000s, trading like it's a meme stock or a crypto shitcoin. We're down 50% in, what is this, 100 something days? Like, here's the thing, and I get it. Like, I definitely get it. The crypto market's scary. It's the Wild West. There's a lot of stuff going on in it that is sketchy, and you got to be kind of careful about where you're putting your money and things like that. I will be the first to caution you that crypto, while I'm heavily invested in it and I'm a big fan of the space, and there's a ton of awesome innovation goes, it's the Wild West, and there are risks. There's a ton of risks. But you can't tell me it's any different than the stock market. The stock market's a casino, right? There's stocks down, I mean, let's take a look at Robinhood here. Yeah. Crypto, right? The SEC needs to protect investors from Bitcoin. That's why we can't have a Bitcoin ETF, because it's such a dangerous asset and we need to protect investors. But you can go invest in Robinhood that's down 85% right now. All right, we're doing this. I'm gonna get petty about it. Yeah, you can invest in GameStop that's down 63% right now. You can invest in AMC that's down 76% right now. And by the way, like this whole bear market downtrend thing is relatively fresh. We're pretty new into this idea of a downtrend. And yet some of these assets are down 70+%. But hey, crypto market's too sketchy. You gotta be careful about the crypto market there. These can get so much worse. Like 90% plus worse. Like real bad. I'm not saying they will. I'm just saying they can. And I'm also saying that it's silly that we can't have a Bitcoin ETF when Bitcoin is less volatile than all of these multi-billion-dollar stocks that I'm talking about. Bitcoin's $1 trillion asset. Like, it's the chances of it going to, levels that are so scary that we haven't seen it before, or breaking market structure altogether, or, any of these number of things that people are concerned about, is pretty low when it's $1 trillion asset, right? Anyways, I'll end my rant there. We should have a Bitcoin ETF. As far as navigating this stuff goes, though, I'm not saying it's going to go down forever. Not even close. I'm simply saying that it's hilarious that crypto is considered so much more scary and volatile when, massive stocks like this are trading like garbage. Anyways, continuing on with this entire idea of navigating this bear market, right? We've talked about commodities, we've talked about bonds, it might be a little bit better to invest in. As far as stocks go, though, and this is my strategy with Bitcoin, and I think this strategy will work if you were more of a stock guy than a crypto guy, is dollar cost averaging. But I dollar cost average in accordance with a logarithmic regression rainbow. I'll show you what this looks like. So, as you can see, these are just logarithmic regressions that are fit to Bitcoin as an asset. Actually, and I'm gonna go to the more complete screen here, right? So, this top red line was fit to the 2013 peak, and we will never get back to that red line again, just because, and it's fit to one data point, so it's not a very useful line. And as you can see here, I have the majority of these lines are not shaded. They're just lines, right? But then you can see these bottom three are shaded. And the reason why is because Bitcoin has spent the majority of its time in the shaded region. And we have, right there. So here's Bitcoin, its entire lifespan as an asset. And we have spent, I'd say, upwards of 50% of the time in the shaded region. So dollar cost averaging is great. And for those who don't know what dollar cost averaging is, it's rather than buying and locking yourself into one price point, once a month, you take a percent amount that you're comfortable with of your income and putting it into the market consistently. And what that does, and people have seen me do this before, but if you put everything you wanted to put into Bitcoin in this area and then stopped, you have been getting crushed the past 18 months or so, right? Or however long we've been doing this. Can you explain the log? Yes, I will explain more about the Slug Rainbow here. Well, and for those that don't know, right, logarithmic regression curve. It's just taking data and fitting it to a logarithmic regression. It's really helpful for things that have exponential growth or just very sustained uptrends, and you have this nice logarithmic curve that eventually normalizes it. Actually, if you look in macroeconomics, this is a sidebar, and I'll totally admit it. Um, but there's this thing called the Solo model, which calculates a country's capital accumulation. And the thing is that the more capital that you have, the more money that you have to spend maintaining that capital. And so you get just this thing that looks a lot like a logarithmic regression curve. You're heading towards a steady state, right? So you're heading towards this level that's there's only so much room for upside because you have to handle all the stuff that you did before that, basically, right? I'm grossly oversimplifying here, but if you want to learn more about graduate level economics, I'm happy to explain it in greater detail. Anyways, Bitcoin, just like any other asset, as it increases in market cap, you're going to have diminishing returns to your investment. In the same way that countries go on these massive booms when they develop to a first world nation, and then it just levels off eventually, right? Like you can only go from a third world country to a first world country once, and then after that it's maintaining being a first world country, right? So when you have a market cap that's increasing, it takes more and more effort to push the price of the asset up. And I've explained this before, but the reason why is because in order to double $100, you need $100, $200, right? In order to double $200, you need $200. In order to double 400, you see every doubling there, you need more and more money in order to actually create that 100% gain. So when you have, an asset with a market cap of $1 trillion, it takes a lot of effort to push that asset up another 100% because you need another 100 or another $1 trillion. While back when Bitcoin was, its market cap was worth 100 million, you only needed 100 million. It's a lot less money than $1 trillion, a significantly lot less money, right? So that's kind of how you get these logarithmic fits. Is your return on investment is just not going to be the same. I'm sorry to tell you, right? If we had the same return on investment in 2013 from the bottom to the top, and let's just take the bottom of this middle range here because it will illustrate my point just as fine. Right? We had, what is that, a 10,000% gain from December of 2012 to November of 2013, right? 10,000%. If we saw that same return on investment from, let's even, and again, we're gonna give the benefit of the doubt here, from the bottom of the COVID low, right? And I'm gonna have to shrink this a lot actually before I even do this. Hopefully it's enough headroom. And we're going to go up 10,000%. If Bitcoin had the same return on investment and made it to this, this band here, and shit, it can't even make it that band with 10,000%. It would be worth, what is that? $400,000 right now, right? In the same time span, right? That's just not happening, period. So what you get is these curves that level off to a more steady state, right? As these move on, they're gonna increase, but they're gonna increase less and less. And it's gonna kind of level off and increases monotonically. But with that, right, the majority of the data is fit to the shaded region. So with that, then, and we're in the shaded region, by the way, I dollar cost average heavier when we're in the shaded region. And the lower we go into the shaded region, the heavier I dollar cost average. This is my strategy. I'm not saying it should be yours. This is not financial advice. This is just what I do to navigate, especially a bear market, right? Because the thing is that we might spend a lot of time down here. We might spend a little time down here. We're not sure, right? We might, take this and hang out and then move our way back up. Frankly, I think that's the most likely scenario, is that, we go to here. Let me switch to this chart and open up my moving averages. I spotted a while ago, and I have tweets to prove it in case you like receipts or whatever, this confluence between the 100-week moving average and this particular logarithmic regression band there, which is presently sits at $32,000 roughly. I think there's a good possibility we'll go below that, but I don't think much longer if and when we do. I think we'll kind of level off at that low $30,000 range because there's a lot of support baked into that, right? And if we strongly break beneath that, then, the bottom of this log band is 18,000. That's hypothetically the absolute lowest we could possibly go. The 200-week moving average is at about $20,000. The logarithmic band after that is at $25,000, and then we're back at the 100-week log band confluence there, right? So potential levels, $18,000 to $30,000, 18 being absolute worst case scenario. And when I say absolute worst case, I mean that we have left this log band once ever, and that was the COVID 2020 capitulation, and it was so short that we were back in it within a matter of 48 hours. So pretty reliable that we can use this log band as a potential bottom indicator. So anyways, like if we go into this purple region, like I'm dollar cost averaging very heavily because I know that eventually we'll make it out of the shaded region and start moving up again. And when we do, literally every buy that I made inside the shaded region is a good one, right? I will be completely in profit on every single buy that I made in the shaded region once we exit the shaded region. And we do exit the shaded region, and we will exit the shaded region. But right now we're in the shaded region, so I'm dollar cost averaging, and I will continue to do so. Great way to navigate a bear market. The other great way, because I don't have logarithmic regression bands for every asset that I invest in, is using moving averages. And I'm going to get rid of the log regression here. And let's use, I don't know, Facebook. Facebook's a bad example. You know what I love about Facebook is every time it crashes so hard. And I don't know why, because I don't think it like totally deserves it. I just think that Zuckerberg's kind of a wacky CEO, and their business model has trouble figuring itself out sometimes. That's my speculation on that. And as you can see, we're insanely oversold on the weekly. Like this should eventually stabilize unless Meta's just, done for and going to zero. But I don't think a company that's been around for 2 decades will. Back to moving averages. Right. So I have a 20-week moving average, a 50-week moving average, a 100-week moving average, and a 200-week moving average. Right. And again, you can use moving averages in a similar way that you can use a log regression band or a key level of support or anything like that, in the sense that once you flirt with these levels, like especially the 200-week moving average, like think about that. That's data from the past 200 weeks, 4 years of Facebook being around. It's pretty safe to say that if you're at or beneath that like it's not a horrible time to be buying, so long as, the asset is fundamentally good and should appreciate over time and things like that. Like that's where you can lock in some pretty good buys. Just saying. And again, I don't personally own any Facebook stock, and I'm not trying to say that you should go and buy Facebook right now. I'm simply saying that it's below its 200-week moving average, and to be under a price, an average price of the past 200 weeks of your asset existing is pretty tough to do. I mean, you can see we've been underneath Facebook's 200-week moving average 1, 2, 3 times ever. Let's take a look at the return on investment if you bought beneath the 200-week moving average. So low to high on the first time, you would have made 83% on your investment. Low to high the second time, you would have made 178% on your investment. The rest is to be seen. Let's take a look at Apple. Apple very rarely touches its 200-week moving average, right? We've touched it and been beneath it. We've been beneath it, right? Once, twice, 3 times, 4 times, 5 times, 6 times. 7. We've touched it or gone beneath it about 8 times since the 90s. And same thing with the small market cap stuff. I'm not really going to mess with that over here, but let's take a look at it. 800%. If you bought beneath the 200-week moving average, and your return on the investment of that respective top would have been 800%. Next time would have been 143%. Next time, 162%. And the COVID 2020 time, 400%. Man, Apple's crushing it. I knew this, but that's incredible. If you look at this, that's pretty amazing. At least I think so. That's just a never-ending bull market. You don't see a lot of stocks that look like that. I can keep doing this to continue to illustrate my point, but I think you're getting it, right? If you touch the 200-week moving average and it's an asset you fundamentally believe in, it's a pretty safe bet that you're not going to see too much downside after that. And this works for Bitcoin too, right? Bitcoin has been at its 200-week moving average once, twice, 3 times so far in its existence as an asset. And each time's, man, if you bought Bitcoin at its 200-week moving average in 2015, 8,000% return on investment. If you did it after the 2017 bubble pop, you would have been still 2,000% on your investment. It's awesome. It's killer. Also, I just want to mention, if you have questions, feel free to ask them. We've officially kind of gotten to the let's hang out and have a good time part of the stream. I don't really have any more lesson plan stuff. So now's your time if you just want my perspective on stuff. Have any questions in specific, didn't know what I was talking about at any point in the stream. Now's a fantastic time to be asking those questions. Also, another thing that I should caution is when we're in a bear market, altcoins tend to do worse than Bitcoin does. And to fully illustrate that, Bitcoin is currently down about 47% since its all-time high. In that same time, Ethereum is down about the same since its all-time high of 49%. But here's where it gets ugly, is when we look at altcoins. Polkadot is down 72%. Atom has been hanging in there, but that's down about 50% now. This one's really bad. Cardano is down 75%. Chainlink is down 65%, so on and so forth. All of these are more than 47% or whatever I said for Bitcoin. And this makes sense, right? I mean, Bitcoin's considered the safest of the crypto assets. So all the more risky crypto assets, people are going to exit at a faster rate. Now, I should also mention that, the buys that I made last time things looked this ugly are buys that I do not regret whatsoever. But I also think that, there could be more downside ahead. We're still risk off. We're practicing contractionary policy. But I also, and this is the first time I say this, is we've been talking about being in a bear market for, an hour now, is that I don't know how long this will be sustained for. To me, we priced in all the foreign policy, Russia stuff. We've priced in all the expected interest rate hikes. So what's next to price in? Like, yeah, we'll probably see some downside, and it'll probably be pretty boring and like not exciting for the next few months here. But like, I don't think that we're going to be in like a 2, 3, 4 year long bear market, or it's going to look like the dot-com bubble pop where, it takes literally like a decade for us to get back to a sustainable spot. I really don't think any of those particular, outcomes are super likely, unless we're talking about like society collapse, which I don't think is going to happen. So overall, like, the amount of downside, is definitely, like there's still plenty of downside that you can take at this point. But I also think that we're already down a lot, and we've priced in a lot of the bad news and the things that we think are going to drive markets downward. So maybe the downside isn't, as bad as the potential upside is, right? And again, this isn't financial advice. It's up to you to do your own research and make your own decisions. All I know is that dollar cost averaging is a really great effective strategy, and dollar cost averaging it more heavily when things look this bad almost always pays dividends. And by almost always, that means that if you're investing in good assets with actual value that have shown consistent appreciation over long periods of time. Brandon asks, have you talked about the importance of self-custody in the crypto space, especially with all the financial censoring going on? Yeah. So for those that don't know what Brandon's referring to, like Canada is literally shutting down bank accounts of people that it politically disagrees with right now. And the reasons for why that's happening, I'm not really going to touch on, because I think people, might disagree about my stance about those protests and the things that are going on. But what I don't think anybody should disagree on is that financial censorship's really bad if somebody's trying to, freely use their right to protest or speak or cause, some, inconvenience to the government that it is trying to, have its voice heard from. And yet, the bank accounts are getting frozen. Like that's horrible. And crypto exchanges can do this just as well as banks can. So what Brandon's referring to here is that like actually having a secure wallet with your own key and stuff like that is the most secure way to hang on to your Bitcoin if you fear that sort of thing. I don't think that's as likely to occur in the United States, but never say never. Greg jokes society precedes the collapse. I mean, definitely an option. I guess the only thing that I'll say in reference to that is like, sorry, NASDAQ. And I get rid of moving averages because they're noise right now, right? That's the dot-com bubble. It's awesome. So, a lot of things were scary with this, right? You invested in a bunch of garbage, 9/11, going to war, right? A lot of similar stuff that we're experiencing right now is like speculative bubbles are popping. And I'm not saying we need the dot-com bubble and whatever. But the point that I'm trying to illustrate here is the market did recover. For the NASDAQ, it took, and that line is totally not straight, so it probably took longer than here. I'll just do this the right way. There we go. The NASDAQ did not hit a new all-time high until 2016 from the dot-com bubble top, which was April 2000. So yeah, you were holding a bag for 16 years. That's not a vibe at all. But at the same time, it did recover. And this was probably one of the biggest speculative bubbles to have ever occurred. And we can also take a look at the S&P 500 because it didn't price in this massive bubble pop quite as badly. But you still see a really ugly double top here, right? The cursed McDonald's formation. right? Um, Society collapsing because dot-com bubble and 9/11 and all that stuff, and we were at a new all-time high about 7 years later. And then society collapsing because the Great Recession and the worst economic depression that the United States has seen since the Great Depression, and that is no understatement. And we were at a new all-time high by 2013. And since then, by the way, we haven't really looked back. And I mean, society collapsing in March 2020, right? And we were, well, this is because we printed a ridiculous amount of money, but we were at a new all-time high literally 6 months later. And by the way, if we keep printing money, people missed out on some serious chicken nuggets. Yeah, this is, you definitely got your nuggies rocked on this. Oh man, this is, you could have had 1,600 chicken nuggets, and then at the bottom of the crash here, you only had 800 chicken nuggets. It's pretty sad. I want more chicken nuggets than that. Um, watch somebody like tuning into the stream for the first time, and the first thing that they heard was me saying that I wish I had 1,600 chicken nuggets. By the way, price structure here, just worth cautioning. Very similar on a shorter time frame, right? The good old McDonald's golden arches. And what the S&P did actually is it printed a lower low, which is really scary, and then headed right back up. And that's kind of, I'm not trying to be deterministic in any way, shape, or form, but that's kind of what I see Bitcoin doing, is really scaring the shit out of people by breaking market structure here and going sub 30K and then continuing back up. And again, like, we could also hold this little gray line that I have here as support and just kind of move our way back up. We could break beneath that and just hold the low 30Ks as support and move back up. We can break beneath that and go into this mid 20,000, like I said, printing a lower low and then head back up. Or we can go to the very bottom of this logarithmic regression rainbow at $18,000 and then head back up, right? But the point is that I have a strategy for all of those, and I know what I plan on doing if the price visits any of those levels. And you should too, right? Because that's the downside risk. Basically speaking, the absolute worst case scenario we can go to is $18,000. What are you going to do? I sure hope it's not selling. But you have to have your own plan for these things. And anybody that consistently execute on that strategy for a long time will be successful in the market, period. If you consistently buy, if you consistently execute, if you have conviction on the assets that you're involved in, you're in good shape, right? And I can't say what those assets are, and I and some of them are obviously going to be more speculative and risky than others, but that's up to you as an investor to navigate. The other thing that I want to say too, and we can kind of close off with this, and if you have a McDonald's proceeds to collapse, if you have any questions, please feel free to ask them. But I do want to say something that I think is really interesting, and that is that Bitcoin, more or less, which is going to sound weird, has been in the bear market since March 2020. Wait, but John, we had this big run up and you called this a bull market earlier in the stream and we hit a new all-time high. Yes. But retail exited the market. This was done on low volume. And you can see the volume here, right? There's way more volume going on here than there is down here, right? So this for Bitcoin especially, this has been a really tame bear market accumulation phase. So tame, in fact, that we hit a new all-time high on low volume, right? So I'm not super worried about it, because to me, we've just been in a giant range since basically the end of 2020, and we're just accumulating in that range. And it could look like this, right? Could look like this. Who freaking knows? Could look like this. All I know is that we've been in a range, and that when we break out of this range, there's going to be some fireworks. Because what happens when we break out of this range is that the retail is going to show up again, right? All these guys that got really excited about the market and entered are going to show back up again, and they're going to get ready to probably get hurt again, because those same guys that showed up here are the ones that got scared and were selling here and are selling here. Now, smart money, on the other hand, has done nothing but accumulate, right? let's see, short term. Wait, no, that's not what I'm looking for. I'm looking for Bitcoin illiquid supply ratio. I don't have the premium version of Glassnode, so that's my bad. Oh, it won't even let me see this version of it. If I go to images, hopefully I'm not wasting your. Here we go. So illiquid supply. What illiquid supply is, and I'm going to tap into my on-chain analysis a bit. And one thing that I really love about on-chain analysis that no other stocks have is that I can look at supply side data, right? Markets in general and the price that dictates them is purely supply and demand for the most part. On-chain metrics are basically just supply side, right? Where is the supply at? And one thing that I love about this illiquid supply chart, let's see if I can make it bigger. So what you're seeing here, this is miner wallets, my bad. Okay, I'm just gonna go back to this. Sorry, you're gonna have to look at this like not so fun version of Google. Is that the amount of supply kept off of exchanges in cold storage is at an all-time high right now by a huge margin, in fact, right? Significantly more than where it was at, back during this run up in early 2021 and the bear market that ensued and all those things. Smart money has done nothing but add to their Bitcoin stock and take it off of exchanges and hold for the long term over the past year, right? That's what you call accumulation, and you traditionally see accumulation occurring in a bear market. Greg says, my Coinbase account would like Big Line go up. Big Line might not go up soon, but maybe someday soon, right? And the best thing that you can do when Big Line go down is get more and don't stretch yourself out too far financially. But oops, what am I doing here? Just clicking everywhere. But all I know is that we're in the shaded logarithmic band region, and the lower we go, the more I'm buying. But anyways, and again, this is a strategy that works for me. It might not work for you. But people have done nothing but accumulate more Bitcoin during this time, take more Bitcoin off of exchanges. The illiquid supply, the supply that's difficult to access, that doesn't show up in exchanges, has done nothing but hit an all-time high, which means that supply is the lowest it's ever been. And again, guys, we did some economics earlier. Let's do some economics again. You have demand, you have supply. When supply decreases, price increases, right? Supply has been doing nothing but decreasing. The problem is at the same time, demand has also been decreasing. But what happens when demand shows back up again? That's the only question I think I need to ask here, illustrating my point. This is a different volume chart, just so that you can see that this is consistent across exchanges. I have 3 different Bitcoin charts here, right? More volume going on here than here, right? So if supply is low, but demand also is, when demand shows back up and that supply is still equally as low, right? Price is going to trend up. I don't know when that's going to happen. All I know is that people that have been playing this game for a long time, that are very smart with their money, smart money, are accumulating, and they have been, and they're not stressed out about these, macroeconomic conditions. They're not stressed out about the foreign policy. They're just buying more Bitcoin. And I'm sure they will continue to buy more and more and more of that Bitcoin the lower the price goes, right? So long story short, we've been in what seems to be a large accumulation range for a year and a half now, and eventually we will break out of it. And when we do, just enjoy the ride. People will get stupid again like they did, over here when this is the same time that like GameStop and AMC and all that stuff was going on. It was just this flood of retail traders that all have since been absolutely chewed up by this market and have probably exited until next time the assets do something like this, and then they're gonna run it back and get burnt the same way. So anyways, guys, that's all I got. I'm gonna stick around for some questions in specific, but I've been going for an hour and 15 minutes now. I really appreciate the viewership. I appreciate the support. Most of the people that are watching this stuff, are not like crypto enthusiasts or finance bros or economists or whatever. They're my friends that, believe in, I think, my passion for this stuff, which is really cool. And, hopefully are getting something out of it, right? I think the fact that my audience right now, albeit small, is not finance bros and econ guys is great, because I'm sharing this information with, people that maybe could use it a little bit more than the econ bros and the finance guys, because they haven't seen this stuff for the first time and it impacts your life. So anyways, not to get too corny, but the support from the people that, consistently make it to these streams is definitely felt, and I really appreciate it. And I don't care if there's 3 people here. I don't care if there's 100 people here. The fact that anybody's watching is really awesome and meaningful to me. So I appreciate it. Thank you. Thanks, Hannah. Thanks, Stephen. I'm not seeing any questions in specific coming in, so hopefully I was, pretty decent on explaining stuff. But of course, feel free to message me if you want to follow up or have questions, or are seeking an opinion on things, or learning to educate yourself further. Always happy to help with all that. Hope you guys enjoy the rest of your night. And Thursday and Friday are right around the corner, and then we got the weekend to relax. So have a good one. Peace.